A 71-year-old retired postal worker in Ohio walked to her mailbox on a Tuesday morning, the kind of morning that feels like every other morning in retirement. Quiet, uneventful, routine. She opened the mailbox. Inside was an envelope from the Internal Revenue Service. She held it for a moment, looked at it, and decided it was a scam. She'd heard the warnings on the news 100 times. The IRS doesn't call you. The IRS doesn't email you. She figured the same applied to letters arriving out of nowhere. So she walked back inside, opened a kitchen drawer, and dropped the envelope on top of a pile of expired coupons and grocery store flyers. She forgot about it within an hour. 6 weeks later, her checking account was frozen. Every penny. Her mortgage payment bounced. Her auto insurance payment failed. The pharmacy refused to fill her blood pressure medication because the card declined. She called her bank in a panic, demanding to know what was happening. The bank told her the IRS had issued a levy on her account. They were legally required to freeze the funds immediately. There was nothing they could do. The letter she'd ignored wasn't a scam. It was the fifth letter in a series. Each one had given her a chance to fix the problem. Each one had a deadline. And each deadline she missed quietly closed another door, until every option she had was gone. The final letter gave her 30 days to respond. She didn't respond. So the IRS did exactly what the letter said they would do. This isn't a horror story I'm telling to scare you. This is happening to retirees across the country every single week. Smart people. Careful people. People who paid their taxes on time their entire lives. People who got blindsided by an envelope they thought was a scam. Today, I'm going to walk you through the 5 letters the IRS sends in a collection sequence.
What each one means, what deadline is hidden inside it, and exactly what you need to do the moment you open it. Because by the time you reach the 5th letter, your bank account, your social security check, and your peace of mind are all on the line. Let's start at the beginning. Letter number 1, CP14, First Notice of Balance. Due. This is the most common IRS letter retirees receive. It arrives a few weeks after you file your tax return, if the IRS believes you owe money. It lists the amount due, including any penalties and interest that have already started accumulating. It gives you payment options and a deadline, usually 21 days. A CP14 is not an audit. It is not an accusation. It is a bill. The IRS processed your return and determined that the amount you paid or had withheld doesn't cover what you actually owe. For retirees, this most commonly happens because of insufficient estimated tax payments, under withholding on Social Security or pension income, or a large one-time event like a Roth conversion or the sale of a home that generated unexpected tax liability. What to do? Read the notice carefully. Verify the amount by comparing it to your tax return. If the amount is correct, pay it immediately or set up a payment plan through the official IRS website. If the amount is wrong, respond in writing within the deadline with your explanation and documentation. What not to do? Do not put it in a drawer. Do not assume it will go away. Do not wait for a second notice. Every day you wait, penalties and interest compound. The sooner you pay or dispute, the less it costs. Here's something most retirees don't know. The penalty for late payment is 0.5% of the unpaid tax. For each month, the balance remains unpaid up to a maximum of 25%. The failure to file penalty is 5% per month, up to 25%. And interest compounds daily at the federal short-term rate plus 3 percentage points, which is currently about 7% annualized. On a $5,000 balance, that's roughly $30 a month in interest alone, and that's before penalties. If you owe less than $50,000, you can set up a payment plan online in about 10 minutes. The IRS offers 2 types. A short-term plan gives you up to 180 days to pay in full with no setup fee. A long-term installment agreement lets you pay monthly for up to 72 months with a small setup fee if you pay by direct debit. The interest and penalties continue while you're on the plan, but the IRS will not levy your accounts while an installment agreement is in place and you are making payments on time. That last sentence is important. Being on a payment plan stops enforcement. Ignoring the bill triggers it. Letter number 2, CP501, First Reminder of Balance Due. If you didn't pay or respond to the CP14, the IRS sends a CP501. This is a reminder. It lists the same balance plus additional penalties and interest that have accumulated since the first notice. The tone is slightly more urgent, but it's still a reminder. Many retirees receive the CP 501 and think it's a duplicate of the CP 14. It is not. It is the second step in the IRS collection escalation sequence. Each step is more serious than the last. CP 14 is the bill. CP 501 is the first reminder. CP 503 is the second reminder. CP 504 is the final notice before levy authority. And LT11 is the final notice of intent to seize your assets. Each letter narrows your options. Each letter increases the cost. Each letter brings you one step closer to enforcement. What to do at CP 501, the same as CP 14. Pay or set up a payment plan immediately. If you cannot pay the full amount, the IRS offers installment agreements that let you pay over time. You can apply online for balances under $50,000. Do not wait for CP 503. Every step you let happen costs you more. Letter number 3, CP 2000. Notice of underreported income. This letter is different from the collection sequence. A CP 2000 means the IRS believes you didn't report all of your income. Their computers cross-reference the 1099 forms they received from your employers, banks, brokerages, and retirement plan custodians against what you reported on your return. They found a discrepancy. A CP 2000 is not an audit. It's a proposed adjustment. The letter shows the income the IRS thinks you missed, the proposed changes to your return, and the additional tax, penalties, and interest you would owe if the adjustment stands. For retirees, the most common CP 2000 triggers are forgetting to report a small IRA distribution, not reporting the taxable portion of a rollover correctly, omitting a 1099-K from a payment platform, not reporting income from a side job. It can also happen when a brokerage reports the full proceeds of a stock sale on Form 1099-B, but you only owe tax on the gain. If you don't report the cost basis correctly, the IRS assumes the entire proceeds are taxable. What to do? You have 30 days from the date on the notice to respond. Compare the income on the notice to your records. If the IRS is right, you can agree and pay. If they're wrong, send a written response with documentation. Common documentation includes rollover confirmation letters, corrected 1099 forms, cost basis records from your brokerage, proof that a 1099-K included personal non-taxable payments. Do not ignore a CP 2000. If you don't respond within 30 days, the IRS assumes you agree, and the proposed tax becomes a formal assessment. Let me give you a real example of how a CP 2000 hits retirees. You sold some stock in your brokerage account for $25,000. Your cost basis was $20,000. Your actual capital gain is $5,000. At the 15% long-term capital gains rate, you owe $750. But you forgot to enter the cost basis on your return. You reported the sale but left the basis blank. The IRS sees $25,000 in proceeds with zero basis. They calculate your gain as $25,000 and send you a CP 2000 proposing $30,050 in additional tax plus penalties and interest. The letter looks like a disaster, but all you need to do is respond with your brokerage statement showing the cost basis. The proposed adjustment gets corrected to $750. This happens more often than you'd think. Brokerage firms are required to report cost basis on covered securities, but some older holdings, especially stock purchased before 2012, may not have cost basis reported to the IRS. In those cases, the IRS defaults to zero basis and assumes the entire proceeds are taxable. Keep your purchase records. They are your defense. Letter number 4, CP 504, Final Notice Before Levy on State Refund. This is where the IRS moves from reminders to enforcement authority. A CP 504 tells you that if you do not pay or make arrangements, the IRS will seize your state income tax refund. It also signals that the IRS may file a notice of federal tax lien, which is a public record that can affect your credit, your ability to sell or refinance your home, and your standing with lenders. The CP 504 is not the final notice in the entire sequence. but it is the notice that transforms your situation from an unpaid bill to an active enforcement case. After this point, the IRS has legal authority to begin taking your money. Many retirees who receive a CP 504 panic and call the IRS in a rush to explain their situation. Before you call, gather your records. Know the tax year involved. Know the amount. Know whether the amount is correct. If you call without this information, you will not be able to resolve anything on that call, and you will have wasted time during a critical window. What to do? Pay the balance immediately if you can. If you cannot pay in full, apply for an installment agreement. If the amount is wrong, file a dispute in writing with documentation before the deadline. If you have a legitimate financial hardship, you may qualify for currently not collectible status, which pauses collection activity. A tax professional can help you determine the best option. Letter number 5. LT11, Final Notice of Intent to Levy. This is the letter that emptied the retired postal worker's bank account. An LT11 is the IRS telling you they are going to seize your assets. Bank accounts. Wages if you're still working. And yes, Social Security benefits. The IRS can take up to 15% of your monthly Social Security check to satisfy a tax debt. The LT11 gives you 30 days to request a collection due process hearing. That hearing is your last opportunity to stop the levy, negotiate a payment plan, submit an offer in compromise, or argue that the levy would create an undue hardship. If you miss the 30-day deadline, the IRS can proceed with the levy without your input. They do not need a court order. They send a notice to your bank, and your bank is legally required to freeze the funds within 21 days and then send the money to the IRS. What to do? Do not try to handle an LT11 yourself. Contact a tax attorney or enrolled agent with experience in IRS collections immediately. Request a collection due process hearing in writing before the 30-day deadline. This stops the levy while the hearing is pending. Bring every piece of documentation you have about the tax debt, your income, your expenses, and your financial situation. Let me be clear about what a levy on Social Security actually looks like. If you receive $2,000 a month in Social Security, and the IRS levies 15%, that's $300 taken from your check every single month until the debt is paid. On a $10,000 tax debt, that's over 33 months of reduced Social Security. For a retiree on a fixed income, losing $300 a month can mean choosing between medication and groceries. The IRS also has the authority to levy bank accounts. When they send the levy notice to your bank, the bank freezes your account for 21 days. During those 21 days, you cannot access any of the money in the account. After 21 days, the bank sends the frozen funds to the IRS. If you had $12,000 in your checking account and the IRS says you owe $12,000, your balance goes to zero. Your rent bounces. Your utilities get shut off. Your life stops. This is not theoretical. This happens to real people every day. And in almost every case, the problem started with a letter they didn't open. Let me be very clear about the sequence because understanding it can save you thousands. CP14 is the bill. Deadline, 21 days. CP 501 is reminder 1. CP 503 is reminder 2. CP 504 is the final warning. The IRS can now take your state refund and file a lien. LT11 is the final notice. The IRS can now levy your bank account and garnish your Social Security. At every single stage, you have options: payment plans, dispute rights, hardship status, settlement offers. But those options disappear one by one as you move through this sequence. By the time you reach LT11, your options are the most limited and the most expensive. Here is your action checklist. 5 things to do today. 1. Open every piece of mail from the IRS immediately. Do not put it in a drawer. Do not assume it is a scam. Real IRS letters come by regular mail with a return address inside the letter. They will have a notice number at the top right corner. 2. Read the deadline on every notice. Write it on your calendar. Respond before it passes. 3. If you do not understand the notice, call the number printed on the letter. That number connects you to the IRS department handling your case. Before I give you number 4, let me warn you about something. The number one reason retirees ignore real IRS letters is that they are afraid of scams, and that fear is justified. IRS impersonation scams happen constantly. Scammers call, email, and text pretending to be the IRS. But here is how you tell the difference. The real IRS will never call you demanding immediate payment by gift card, wire transfer, or cryptocurrency. The real IRS will never threaten to arrest you on the phone. The real IRS will never email you asking for personal information. The real IRS sends letters through the United States Postal Service with a notice number printed in the upper right corner of the first page. If you receive a letter and you are not sure it is real, you can verify the notice number against the official IRS notice list. You can also call the main IRS number directly to verify. Do not let fear of scams cause you to ignore a real notice. That is exactly how the retired postal worker in Ohio lost everything in her checking account. She thought the letter was fake. It was not. 4. If you receive a CP504 or LT11, do not try to handle it alone. Get professional help. A tax attorney or enrolled agent can stop a levy, negotiate a payment plan, and protect your assets in ways you cannot do yourself. 5. Check your IRS account online. The IRS offers a free individual online account that lets you see your balance, view notices the IRS has sent you, check your payment history, and download transcripts. If you missed a letter because it went to an old address, your online account will show the notice and the deadline. This is the single best tool the IRS offers retirees, and almost nobody uses it. And one more thing. If you have moved since you last filed a tax return, file Form 8822 to update your address with the IRS. This is free, takes 5 minutes, and ensures that every future notice goes to the right place. The IRS does not need to prove you received a letter. They only need to prove they sent it to the last address on file. If that address is wrong because you moved and did not update it, you will miss every notice and lose every deadline without ever knowing the letters existed. The IRS sends millions of notices every year. Most are routine, but the ones that are not routine can take everything in your bank account in a single day. The retired postal worker eventually got her account unfrozen. It took weeks of phone calls, professional help, and a payment plan she had to commit to on a fixed income she could barely stretch as it was. She still talks about that envelope sitting in the drawer. She still talks about how easy it would have been to open it, how easy it would have been to read 21 days and write a check or pick up the phone. How one moment of "I'll deal with it later" turned into 6 weeks of silent escalation she never saw coming. You have one job when an envelope from the IRS arrives in your mailbox. Open it. Read it. Find the deadline. Act before it passes. That's it. That's the whole game. The IRS doesn't catch people because they're cheating. They catch people because they're avoiding. They escalate because nobody responded. They levy because nobody asked for a payment plan. They garnish because nobody requested a hearing. Every single step in that 5-letter sequence has an off-ramp. A way to stop, a way to fix it, a way to protect yourself. But those off-ramps only exist if you open the envelope. Don't be the person who finds out their account is frozen on a Tuesday morning because they assume the letter from 6 weeks ago was junk mail. Be the person who opens the envelope, reads the deadline, and acts. That one habit, just opening the mail, is the difference between a small problem you handle in 10 minutes and a financial nightmare that takes months to recover from. The letters are not the enemy. The letters are the warning. The enemy is the silence that follows when you ignore them.